Okay, welcome everyone. We'll start a new unit which we are going to start is the financial accounting 2. Today we'll go through LO1 learning outcome 1, understand the relationship between organization ownership and the nature of financial reporting statements. My name Anjum Sattar and my email address anjum@ukversity.co.uk. If you have any question, drop me email. The aim of this unit will be to develop the ability to prepare the financial statement to the international accounting standards. Small and medium-sized enterprise organization will go through IFRS, International Financial Reporting Standards. Learner will gain the knowledge and skill required to enable them to measure the performance of the financial position, small and medium size. That's the key learning by this unit or through this unit. You can develop understanding and a bit knowledge. This in accounting. You're already working in accounting. Maybe you know more than that already. Okay, financial accounting 1 to 10. What do you think? How much we know? Scale 1 to 10. Can we reflect?
We're somewhere in the middle.
7. Okay, good. Great. So today is our key indicative content. What we're supposed to be learn. We'll go through different business organizations, sole trader partnership, limited companies, manufacturing company, not-profit organization, and different reports and income and expenditures. All we'll discuss in these, and international accounting standard and manufacturing accounts. Okay, so first of all, we have a assessment criteria 1.1 is all about compare the capital structure of different organizations. So when we say sole trader is a 1%, 1% investment, all the risk and reward goes to 1%. Sole trader, of course, they also can prepare the accounts as well, which is the profit and loss and balance sheet, and sometimes they prepare the cash flow as well. But normally, it's not compulsory to prepare the statement of change in equity. A partnership, is Partnership Act. We have a 1890. Partnership Act 1890. If we don't have a written agreement between partners, so it should be automatically apply the Partnership Act 1890. Do we know how many partners need to be in a partnership?
2.
Minimum 2 and maximum?
There's no maximum.
Maximum under Partnership Act is a 20. And in some countries, if we are doing insurance and banking business, it can be 2 to 50. That's max, according to the partnership. Otherwise, you can convert into the company LLP, limited liability partnership, then can be many. There is a no limit. It is absolutely right. So limited liability at the company, we follow the Company Act. Do we know which year we are following? Company Act 2006. So according to company is a separate legal entity, and the company has own names, own office, directors, shareholders, especially in the LTD, director are the owner of the company as well. So that's the key. Then the not-for-profit entities, charities, clubs, societies, non-governmental organization, NGOs, charities, we registered in the Charity Commission under the Charity Act. We follow is 2011. So Charity Act is 2011. We follow. So we prepare the statement of financial position, statement of financial activities, annual report to the Charity Commission, sometime an income and expenditures account, and these prepared in line with the statement of recommended practices. In other country, requirement will be different, so we need to be here. We just different types of organization, limited liability. There can be 2 types, LTD and PLC. LTD and PLC. Do we know how much is the requirement? If you want to register PLC, how much investment is required?
It's 100,000. I'm not sure.
It's a £50,000 minimum, and that's required to be registered as PLC, and of course stock exchange. Then we can issue shares to the public. So limited liability, we can register company in the company house. Of course, the different fees. Normally, we can say up to £15. So we can, that's the fees we need to pay to be registered the company in the company house. Okay, so that's we need to be registered. So we have a retained earning, share capital, and loans. We can do the funding capital. So in the sole trader, capital is a personal. In partnership can be through partners. That's why the more funds available in the company. There is a no limits of partners and can be more funds available. We can do equity financing and debt financing. Equity and debt financing. So equity is the shares, and the debt you borrow money through bank loan and various others. So that's the way we can raise capital. Okay, so partnership own advantages, disadvantages compared to the sole trader. So separate, of course, is profit, and the risk can be shared, profit can be distributed. Then if we prepare the partnership accounts, we have appropriation accounts, we can prepare the current account, we can prepare the capital account and goodwill accounts. So that's the Company Act. As we discussed earlier, we can follow IFRS, International Financial Reporting Standard. We normally IS1 is about International Accounting Standard 1 is prepare and presentation of financial statement. Financial statement, whatever we produce, it need to be true and fair. That's give the true information to our user. Then we discuss LLP, limited liability, partnership. We can register, and then company laws will apply as well. So then next we have a 1.2, explain and why particular capital structure is selected. The capital structure of the firm is the best to mixture of the debt and equity financing. Maximize. So if you have a debt financing, which one is a cheaper source of finance? Debt or equity? What we think? If the company need to raise the money, which one is the best option?
Well, equities, you're only using your own money. Debt, you've got to go out and you've got to actually borrow, and you've got to give a return on the money that you borrow, don't you?
Yes, is the interest involved? Yes. So at the moment, we all know the base rate is 0.01%, which is nothing. We can get money from the banks, maybe 2% interest rate, depends credit scoring, risk factors. Yes, 4% or maybe 5% max. Bank is happy to give us. But if we have equity is one is a problem. You issue the shares. When you issue the shares, first of all, you have a limit on registered capital. Yeah.
Yeah.
So how much is the registered capital we have in the company house? We can't issue more than that shares. And otherwise, other thing, if you issue shares, you lose the control. Yes. In PLC especially, then the shareholder can change the director. That's the problem we have. Shareholders expect, at least 10+% return. Of course, if we don't pay 1 year, it's fine. But if we don't pay always dividend, what will be happen? They withdraw the funds and they can invest in other company. So equity financing is expensive than the debt financing. Other thing, we can look around the tax implications as well. So when we look the tax, debt is always is expense. Yes, but equity we pay after the tax. So equity not come under the expense. So after paying the tax, whatever the profit left, we distribute to the shareholder. So that's other implication. So we can save more on the debt instead of the equity because it's a cheaper rate as well. So that's why we need to be focused on gearing ratio. If we have a high gear, high risk, but maybe we can say 60 to 40. So 60% debt financing, 40% equity financing. So that's 55. But normally debt is the cheaper, so a lot of companies prefer to the debt instead of equity. And we have a various, and it can be impact on the goodwill and all others, we need to be really balanced approach. So debt fund we can use is weighted average cost of capital. We can do the average, if it's a lower mixing, always good to be. So however, do the debt increase the financial risk to the shareholders and the return on the equity that they require. So the company have to be find the optimal point, so marginal benefit that's equal to marginal cost. That's we need to. Okay, if any question you can ask, please. So I
No,
included here capital structure. There are a lot of theories. We can look around the gearing ratio, high gear, high return, debt divided by equity. We can find debt to equity ratio, or we call it gearing ratio, high gear, high risk as well. The Then we can look around different theory. There is a traditional views. There is the M&M is called Miller and Mordiani, the model which is, I copy the link here. So according to the Miller, we need to be really good balance approach. There are the other theories as well, like, picking order theory. In these all the theories, they look around in different economics environment, different factors, inflation, interest, tax, and all these, and then we can decide, which is best, and we have a weighted average cost of capital, capital asset pricing model as well, where we use the money, where we get the funds from, and what we can generate. That's all, we can use it. Then the types of industry, always we need to look around manufacturing organization, make goods and sell. We need to look around material. Maybe we can get it uh, through the finance side, and retail organization buying ready-made goods and sell, so finished goods. Here we can maybe look around the just-in-time inventory, or the service organization provide the services. So different organizations, different structure of capital, the fund we can raise. Okay, then manufacturing accounts. Manufacturing accounts, it start with the inventory. If we open our fridge, we have three types of inventory. Do we know types of inventories? Inventory three types. One is the three types. And first is the raw material. Second is work in progress, or we call work in process. And the third is finished goods. So when we prepare our account, so we're looking the cost of finished goods. Opening inventory, raw material plus purchases minus closing, we can find how much material we used. Then we have a labor cost. Then manufacturing overhead, we can find the manufacturing cost. Then work in progress, opening minus closing. Then the cost of goods manufactured, and then we opening inventory of finished goods, and we can find the cost of goods sold. How many goods we sold it, and how much is the cost. So that's the way we can, and this figure we can use in our purposes for the balance sheet, statement of financial position and statement of comprehensive income. I included two company statement which we can explore their statement of comprehensive income, Morrison and Sainsbury. So just a matter of copying the link, and we can look around the cash flows. Cash flow, do we know how many activities we have in cash flows? Cash flow statement. Three areas we look the cash flow. Operating activities. Operating activity mean our normal business. Then we have investing activities, and then we have financing activities. So we can raise money, our money in and out through operation, through our investment, and through finance. You settle your liability, or you raise more money through increasing liability. So that's, the three ways. And if we go through in the following lesson, we have a International Accounting Standard IAS 7. International Accounting Standard 7 we follow to be record inventories according to IAS. So we can copy Morrison for here link. and we can look around the statement. So if you want to download, you can as well, and we can look around these the company statements. And within we have a profit and loss, always good to be. We have a CSR reports. We've been given financial highlights here as well. So that's how much dividend they paid, 8.77 pence. The dividend every share. So it change is 30.4% change from the last year. So they paid, big because Morrison earned more profit in that year. Due to the COVID-19, many stores were closed, and in these supermarket earned more profit this period due to the COVID-19. Okay, so we can control F. We can go through income statement. So consolidated on page 78. So we can. So we So all these are the statements. We can look around the Morrison consolidated financial. So may the company have so many subsidiary companies. So we've been given the cost of sales, revenue, gross profit the year 2020 and 19 is gross profit is 681 million was, and the last year was 652 million, so it went up overall. Then operating profit we can say, and after tax 314 million. The last year was 233 million, so it went up. How much earning per share was, slightly went up as well. Oh, sorry, it's good, the went up because EPA basic was 9.89, now is 14 point. So that's we can look around financial position, non-current asset of the company. This year compared to that went up. They invested more money in the non-current asset, be business, property, plant, equipment, and current asset of the company compared to that went up. Current liability of the company compared to the last year, it went up as well, 3396 now, and then non-current liability is went down. Non-current liability went down, so it means they have settled some liabilities. Then the net asset is went up compared to the previous. Shareholder equity, which we call, yes, our capital structure. This we can see is went up. So we can find it how much is that, how much is the equity. Then statement of cash flow, operating activities, cash went up. Investing activities, cash went down, outflow is more than inflow. Then financing activities, cash outflow, and the net increase and decrease. At the end, we have an overall cash position is a better 305 million net balance, and 264 was the last. So that figure shows in the statement of financial position as well. Statement of change in equity, we can look around how much dividend they paid and all the information. So these are the financial statement. We can compare with other companies as well, and we can make the decision based on these the statements. Okay, 3.1.3, we can analyze the effect of the capital change. So partnership, as we discussed earlier, have a different layout. Sole trader, partnership, then the profit will be distributed between the shareholder, between the partners. This is the one of example. The partner's salary is expense for the business, but is the income for partners. Interest on capital is expense for business, but income for partners. By a sole trader is a 1%, so we don't need to be distribute like this. And the companies can be many, and that's why we prepare the statement of change in equity statements. So that's we'll see. Then they have a capital account. Different partners we can prepare separate their current account. How much the partners are through that we can show in, and we can add new partners. Can join and leave, and then the goodwill effect can be, and we can make adjustment. The goodwill we can raise and we can eliminate. Always goodwill goodwill is an asset. Of course, if you're many years in the business, a new partner join, they have to pay more capital or more investment than you, and that's you can look around that double entry treatment. So first we create the goodwill, debit the goodwill, credit the partner's capital account, then debit the capital partner account and credit with the old and new ratio. That's the key treatment. Okay, then we have assess how the chain capital structure, and we have a different regulatory framework we have to follow. So when we change, we have to look around the gap, general acceptable accounting practices in UK. We need international accounting practices. We need to look around in a company. We need to follow the company act as well. Okay, accounting standards. We need UK accounting standards and international accounting standard. We can, and this can also impact the layout and the then international financial reporting standards. We have EU's and all international as well. So we need to think about is the principle based approach in the UK we use, and some rule based approach like in Germany and other the more rule based approach they use in accounts. So that's the purpose of financial statement, financial position, asset, liabilities, and capital shows financial performance. If you want to see, look around and the changes in the cash flows. Conceptual framework, which is we need to set the principle and the rule. International Accounting Standard Board, IFRS, set all these. Objective of financial statement journal to provide going concern. The business will carry on as a normal. Accrual basis is also known as a matching concept. Income and expenses should be matched in the year when those incur. Any questions? Yes?
No, that's fine.
Okay, then we need to look around the next. We can do the comparative statements as well, where we can see the capital 2 years, and we can look around the Morrison at Tesco like we've seen there for, and we can look around the notes as well. Accounting policy changes happen, like we have IFRS 16 which is being changed. IAS 16 was property, plant, equipment. Inventory need to be recorded, lower the cost or net realizable value. Like if we have a Window 98 CD, when we bought it, maybe we bought it £200, but now the value may be less than £10 even. So that's we should be £10 now, because we want to make sure we'll to provide the true and fair information. Then all the elements of financial statements, how we can asset is controlled by entity, which will slow the future economics, benefit, liability, legal obligations. So all been explained, and these terms we use. Accounting equation that's make and if you have a net asset always equal to the capital. So we can look around different companies. So other than that, I'm going to give you the handouts. This we can look around, which is the statement of cash flow, then other statement, journal entries, adjustments, all in the standard we have. Other than this, these booklets will be on Moodle, so we can look around further, but most of you all working in accounts, so you already know the stuff, So thus we have incomplete record, partnerships, and limited companies, all the accounts, how we can, and capital structure layout, all being explained. So if you want to do some questions, so please look around as well, and the next lesson will go through LO2. So that's
So
all.
will these slides, the slides and the recording will be uploaded today, won't it?
Yes, will be available on Moodle, and this booklet, if you want to look around the question, or the matching concept, which are going concern, or the qualitative characteristic about financial statement as account, and we need to be, and those always in the notes, we reflect as well our policies, which accounting standard we use. And normally, if I'm not sure, if you're using Sage, and in Sage there is a called Sage Production. If you're using the software Sage Production, so that is a very vast, big companies, PLCs use. where you can find, all the gaps and everything updated automatically. Behind the
Yeah.
scene, software company carry on adding and updating, accordingly.
Okay.
And that's, and in the notes, even we can include notes if you're using Zero as well or any other software. Yeah?
Do you know when you're talking about debt and equity, is it always going to be that way? I mean, because we're in this situation now where interest is such at a low. I mean, I'm of an age when I remember when interest rates were much higher. So I mean, and we've had higher tax rates as well. But I mean, is it always going to be that debt is always going to be? I mean, it just seems to be the modern world. Everyone seems to want to carry debt. I mean, whereas if we go back 25 years ago, that wasn't the situation at all, was it?
Yes, you're absolutely right. So we can argue in that at that point, what was the decision to be best. But always as an investor, they are expecting more than this, because if I can deposit money to the bank account, secure my return, why I'll go for share? Because the share business is very risky. So
Yeah,
higher the risk, higher the return. So as
yeah,
a company point of view, it costs them more.
yeah,
So that's why we need a mixture. That's why normally we say don't put all your egg in one basket. So to
yeah.
quantify the risk in the business, we want to be separated. And because the
Okay.
cash flow different timing as well. Because as a
Yeah.
company, we want to be strong, cash flow, and our cash position should be good. So that's why we want to be mixture of it. And the tax side as well, because there's a saving of 20% straightforward tax and 19% corporation tax. So
Yeah.
because debt financing is expense, so by law I can include in the profit and loss as expense
Hmm.
all the interest. But the dividend I can't include it. Dividend paid after the tax.
Yeah.
So that's it. You're absolutely right. The way where you're coming from, because of course at that point tax was even rate interest was 7%, but the bank used to give even 10 and 11%. Like it's still
Yeah.
in some countries. So in some countries, people are are investing money in other part of the world because high interest
But
rate.
isn't all, there's a restriction on what companies can actually write off to debt? Because I mean, it's isn't a maximum of 30% of EBIT, and so I mean, when you get to a certain size, you can only actually write off so much debt. I mean, you've got your debt equity financing, so it's I mean, the idea is to try and move away from these highly geared companies.
You're absolutely right. That's other areas really, because the trust of the investor it can be low as well if you're
Yeah.
because they're thinking, come on, whatever will be left, if you're 60-80% you have a debt, 20% left of that, and you own the company only 20%, 60% companies institute the financial institution who gave you the lender. So
Hmm.
technically you own it only 20%, so it's a high risk as well.
Yeah.
One way you're saving, but you're putting the risk, as well.
Yeah.
So that's, really we need to be, that is come, more management accounting side where our
Yeah.
the broader level are we and as a company and the mission, what strategies we have, and what investment and where we do. What purposes we are borrowing money. That's all we need to keep in mind. Okay. Any other question?
No, no, that's fine.
Brilliant. Thanks, Jen. Have a nice time and I'll speak to you
You
next
too,
time.
Andrew. Thank you very much, and look forward to speaking to you next week. Thank you very much.
Welcome. Enjoy weather. Thank you. Bye-bye.
Thank you. Bye bye.
Bye.